Hey, welcome to another Coffee with Kirk. I hope you're doing well. Today we're going to talk about a topic that usually just instantly puts people to sleep. Taxes. Now, taxes are boring. We like to talk about taxes, but they're very, very important to your financial future. And we had some pretty big changes with the passage of the big beautiful bill recently. So that's what we're going to go through today. Now, I know in the media, most of the talk was it was just extending the tax cuts from 2017, the Tax Cuts and Job Act, the first time that Trump was in president. He was his first term in the presidency. And all it was just an extension of, what he's already done, which, for the most part, there's a lot of truth to that. It was essentially making a lot of his 2017 tax cuts either permanent or extending them. But as always with taxes, the devil is in the details. And there are some little nuances that need to be paid attention to and some new little twists in the tax code. So we'll go through those today so you're kind of ready. A lot of the tax breaks start instantly. So they happen in 2025, so we could take advantage of them. But a lot of them don't start until 2026. So we'll try to hit on some of those as well. So as I always love to do, we'll jump into some slides and discuss that. Okay. So the biggest thing is, for the most part, all of the tax brackets that were created in 2017 under the Tax Cuts and Jobs Act, under President Trump's first term, they're going to remain in place. So they were actually set to jump up about 3 or 4% for each tax bracket if they went back to the 2017 levels. So they did make those permanent. So we're still going to have the 10, 12, 22, 24, 32, 35, and then finally the 37% bracket. Now, there is one little thing that they did do. They actually expanded the amount of income that's eligible to be included in the 10% and 12% tax bracket. So as you can see from this chart, under the TCJA, the 10% tax bracket phased out once you hit $12,116 of taxable income. That jumps up slightly to $12,341. And the 12% tax bracket was due to phase out or close out at $49,225 under the old rules. Under the new big beautiful bill, it goes up to $50,142. Now, those aren't huge differences. We're talking less than $1,000 for each of them. So it doesn't seem like a lot, but I guess if you're in the 10 or 12% tax bracket, the two lowest brackets, you have income 50% or lower. Now, this is taxable income. So when you throw on your standard deduction, for a married couple, that's another $30K. So you could have $80K of taxable income and still remain in the 12% tax bracket. So it's not an enormous amount of money, but hey, look, if you're in like I said, if you're in the 10 or 12% bracket, every little dollar helps. So that's one good thing. And the other thing to remember is, because we have a progressive tax code where you pay part of your taxes at 10% and then 12 and then 22. So even somebody who's in the 37% tax bracket, they are eased into that 37%, starting off with 10%. So even they will get some small little benefit from this. Okay, and so that was for single. Here you can see for joint folks. I probably sort of screwed that up when I talked about the standard deduction for joint, but for joint folks, it's even more. So the 10% goes up to from $24,231, which is the current rule, to $24,682. And for the 12%, it jumps from 98,450 to 100,284. So again, not huge amounts, but every little bit helps. The one thing that's kind of an odd, and this is sort of more a nuance for tax nerds like me, financial planners and CPAs who get into the nitty gritty. But there's been a rule in place for a long time. Probably dating back to President George W. Bush, where if you were in the two lowest tax brackets, then any capital gains that you had resulted in a 0% capital gains tax rate. So ordinarily, you're going to be paying a 15% capital gains rate if it's a long-term capital gain, meaning more than 1 year. So you held the security, the bond, the real estate for more than a year. If it's less than a year, it's just ordinary income tax rates. That's always been in place, and that will remain in place. But the weird thing is, with the change in the tax rates now, they didn't adjust them to fully incorporate the capital gains 0% threshold. So if you look at the rules for 2025, so 2025, we're still going to be using the capital gains taxation rules from the Tax Cuts and Jobs Act. So when you look at it, basically for a single filer to be in the 22% tax bracket, you're looking at $48,475 of taxable income. So that's after your standard deduction or itemized deductions. And for married filing joint, it's $96,950. Now, to what they would use for that 0% capital gains threshold for single folks, it's $48,350. And for married filing joint, it's $96,700. So pretty close. If your taxable income was for a married couple, $96,700, any amount of that was capital gains, you would pay no tax on. So there was really only $250 difference between the ordinary income tax rates and the capital gains threshold. Not real big. But they didn't make any adjustment really for the increasing the 12 and 22% tax brackets, or the 12% tax bracket for the Big Beautiful Bill. So again, for the Big Beautiful Bill, for a single filer, you're going to be able to have up to $50,142 of taxable income and $100,284 for married folks. But the capital gains threshold is $49,098 for single folks and $98,196 for married filing joint. So there's $1,000 difference for single and almost $2,100 for married. It's a little small thing that probably you don't need to think about, but you got to make sure, if you're trying to take advantage of 0% capital gains rates, that you as a tax preparer, if you do it yourself, or your CPA or financial planner, that they're taking that into effect. And the other thing you have to remember with this, the capital gains, while you will pay 0% tax if you qualify, the capital gains is included in your total income level. So for that $50,142 for single folks and $100,284 for married folks, if you take $50,000 of capital gains, then if you're single, you've only got $142 of other income that you can have. Otherwise, you're going to end up paying 15% on your capital gains. I've had this happen before where a couple, they own some property in Poland, and they were, based on their other income, their W-2 income, their interest and dividends, all of that, they were going to be in the 12% tax bracket. So, they had like 70,000 of of income after their standard deduction. So they're like, oh, well, we're in a 12% tax bracket. So that means we can take capital gains and we won't pay any tax on it. So they sold this property in Poland and made like $300,000 of long-term capital gains. So they'd owned it for a while. They didn't realize that $300,000 is added into the calculation of the tax brackets. Now, while the capital gain is kind of pulled off on its own, and the tax on that is figured at 15% and not your ordinary income tax rates, it still is included in the total amount of income. So they really had, $375,000 of taxable income. Now, $300,000 of that was carved out and taxed at 15%. Well, they were expecting a 0% tax on it. And even at 15% of a $300,000 gain, that's a $45,000 tax bill that they were not expecting. So you have to remember, even if you're in this situation and you're going to try to capitalize and sell something at 0% capital gains rate, you have to be careful to not go over these limits. So just a little, for you tax nerds out there, just a little thing to think about. Now, another thing to be thinking about for taxes, the standard deductions going up. And this is going to take effect this year in 2025. So it happens immediately. If you were single, you were going to get a standard deduction of $15,000 this year. But it's going to be bumped up to $15,750. And for married filing joint, it was going to be $30,000. Now it's going to be $31,500. So you get a little bit of a bigger deduction for everybody. It's not a huge amount, but like we said earlier, every little bit helps. So you can expect a larger standard deduction this year. Now, if you happen to be over 65 and are considered a senior, well, even more good news for you. For the next 3 years, starting this year in 2025 and going through 2028, so technically, I guess, 4 tax years, you're going to get an extra $6,000 standard deduction if you're single, or $12,000 if you're married. Now, this does have a phase out, and the phase out does hit pretty quickly. So you start to phase out, it's 6% of the income above $75,000 for single filers and $150,000 for married couples. So once you get back past those figures, we start to phase out. Every dollar of income is phased out at 6% of that. So you're going to be totally phased out for this extra amount if you make $175,000 single and $250,000 joint. Here again, I'd like to remind you that the capital gains is included in those figures. So if you have a large capital gain on something, you probably are going to get phased out, at least partially, for getting this full $6,000 or $12,000. Now, the other wonderful thing about this is even if you itemize your deductions, you can still take advantage of this senior increase in the standard deduction. So it isn't technically added to the total standard deduction that you would get. So if you don't itemize, this isn't just an increase in the standard deduction. It is literally a separate deduction on its own for those who are 65. So you could still itemize and you'll get this deduction for being a senior. It's what they call a below the line deduction. So again, for tax nerds, we like to talk about above the line deductions and below the line deductions. Now, what's that line? What's it mean? Well, it's called the adjusted gross income. When you're doing taxes, a lot of your tax credits, your deductions, they're all predicated on what is your adjusted gross income. And if you're, so it's a critical number when you look at a lot of your different tax, especially tax credits. Like if you have kids in college, the college tax credit is based on your AGI. Same with things like if you have kids in daycare, if you're I mean, essentially every credit is based on the AGI. So everything above the line reduces your AGI. So those are always really good deductions. And then everything below the line, it doesn't reduce your adjusted gross income, but it reduces your taxable income. So we're getting in the weeds, and you can already see why I say people fall asleep when we start talking about taxes. But this stuff's important to understand. So this is one of these things that it will reduce your taxable income, but it does not reduce your adjusted gross income in any way. So just a little nuance there. Like I said, devil's in the details, folks. So this will give you a little bit of an idea of what it's looking like for you if you're single or married filing joint, as far as what kind of deduction you're going to get. Now, the beautiful thing is, if you are taking the standard deduction, if you normally do that and you do not itemize, there's always been an extra little amount for people who are over 65 or are blind. So like a single filer who's 65 or older always got an extra $2,000 above what folks under 65 got for a standard deduction. And for a married couple where they're both over 65, that amount was $3,200. If only one spouse in a married couple was over 65, it's $1,600. That still exists. They're still going to have that. That is part of the actual standard deduction. Okay, so if you itemize, you do not get the $2,000 or $1,600 per person for married filing joint folks. You don't get that if you itemize, but you still get that if you take the standard deduction. So this $6,000 per person is on top of that. So if you are single and over 65 and you take the standard deduction with the extra $2,000 plus that $6,000 new deduction, your total standard deduction is going to be $23,750, quite substantial. If you're a married filing joint couple and you're both over 65, you're going to get $46,700. So remember, if you're married filing joint and that 12% tax bracket goes up to roughly $100,000 of taxable income, this means you can have $146,700 of gross income and still qualify to be in the 12% bracket and take advantage of that 0% capital gains rate. Okay, so that's a pretty nice little thing, and this is only through 2028. So if you do have some large capital gains that you've been sitting on, you might want to construct a way with your financial planner or CPA of how to take those gains now and not pay tax on it. Okay. So one of the big news stories out there, and actually one of the promises that Trump had is, no tax on Social Security. And the Social Security Administration put out a statement once this bill was passed saying that 90% of people receiving Social Security benefits will not pay tax on their Social Security. Now, this is false, sort of. Okay. So because of this new over 65 standard deduction amount, it reduces all income, not just your Social Security income. So the stat that the Social Security Administration put out there about 90% of people not paying tax, all that really did is said, okay, with this extra $6,000 for single or $12,000 for married couples, that will eliminate what they would have paid in taxes on their Social Security. It doesn't mean it was actually targeting the Social Security. So if you're over 65, you still get this standard deduction amount, even if you're not yet collecting Social Security. So your income is going to decrease if you're over 65 with no Social Security income. So if you were just getting, say, dividends and interest and maybe some, pension and or maybe something from your 401k, you're still going to get that. Okay. So there is no reduction of Social Security taxes. You're just getting an extra standard deduction. Now, a lot of people, because they thought Social Security was going to be not taxed, they're thinking they can do more Roth conversion because the Social Security will not be taxable. That is not the case. So do not do that. The rules for Social Security taxability are still in place. And those rules are, if you're single and your income is $25,000 or less, then none of your Social Security is included on your tax return. So if you make $25K, none of it's included in taxes. Then you go from $25,000 up to $34,000. In that case, basically you're going to pay 50% of your Social Security will be included as taxable income on your tax return. Okay. And then once you get past $34,000, 85% of your Social Security income benefit will be included on your tax return. So you can see, really, most single folks are going to be paying, tax at 85%, of their Social Security benefit, because most people, once you factor in, and I will say, with the 25,000 and the 34,000 figure, that does not include Social Security. That's other income outside of Social Security. So, a lot of people are going to have IRA distributions, 401k distributions, interest, dividends, and they're going to get over that 34K mark. So that remains in place. Now, for joint filers, instead of being 25% or 25,000 for single folks, it jumps up to 32,000. So if you have 32,000 of income outside of Social Security, you pay no tax on your Social Security. 44,000 is that figure that you hit 50%. And then over 44,000, 85% of your Social Security is included in taxable income. So again, these are not big figures. So there is no truth to Social Security not being taxable. It's still in there. You just get more of a standard deduction. Now, another big change, and this was kind of fought for by some of the higher tax states like California, New York, New Jersey, Maryland, is to increase the amount of SALT itemized deductions. What's a SALT deduction? That's your state and local tax deduction. Now, again, what this is, it's both of your property taxes paid plus state income tax paid. It's both of those together. Now, with the 2017 Tax Cut and Jobs Act under Trump's first administration, they capped that at $10,000. So between your property tax and your state income tax, you could only deduct $10,000 of that. Now, before the 2017 Tax Cut and Jobs Act, you could deduct 100% of your property taxes and 100% of your state income taxes. So if you're in California, you could imagine if you're in the top bracket at 19% and you made $1 million, that's $190,000 right there just for your income tax. And then I'm assuming if you're making $1 million, you probably have a nice house, so you probably had a big tax bill, maybe another $20,000 or $30,000. So you could have easily over $200,000 deduction if you were in the top tax bracket in California. And then you wake up in 2017 and you're capped at $10,000. So, obviously a lot of those folks were very upset. So they've increased the amount up to $40,000. Okay. The other thing is they also let you phase out a lot shorter in income than before. So you can kind of see this does take effect in 2025. So you will benefit from this year if you itemize, and you're in that situation where you have a lot of itemized deductions and a lot of property taxes or state income tax. So it happens right now, but it does start to phase out once you make $500,000 of income. And this is the same figure for single, head of household, or married filing joint. Now, if you're married filing separate, you can kind of see you only get $20,000, which if both partners are filing tax returns, they both have to itemize. So they both still get $20,000 each, which is $40K, and it phases out at $250K, which when you factor in two people doing it on two different returns, that's $500,000. So there's really no difference if you do married filing separate. But there's no benefit to doing married filing separate. The government makes sure you don't get a benefit to do that. So you can kind of see how this works. So this will be good for a lot of folks in higher tax states. Also in states with no income tax like Florida, Tennessee, Texas, South Dakota, Washington State, you still can deduct your sales tax. So if you are spending like a drunken sailor and you have a ton of sales taxes, maybe you bought a car and a boat in the same year, maybe you bought a car, boat, and RV, and you've got a lot of taxes, well, you might be able to itemize and take advantage of having these higher SALT limits. The other thing is the SALT deduction does actually go up over the next 4 years. Well, really 5 years. So it starts this year at 40,000, but then it keeps climbing to the point in 2029 when the SALT deduction will be 41,624. And you can also see the phase out range also goes up accordingly. So you can make a little bit more money and get a higher SALT deduction. Now, once we hit the year 2030 and later, it goes back to $10,000. So this is probably something that it will depend on which party's in power in 2030, and also what's our fiscal situation. And in the spoiler alert, it's going to be bad. So we'll see if this thing gets extended past 2030 or not. Okay, there's other itemized deduction changes, and these start in 2026. So these are not effective right now in 2025. They're going to be starting in 2026. So you can ignore these if you're doing any kind of planning for this year. These will take effect next tax year. But they are enough of little nuances. One of them that's been pretty big is you can now deduct your mortgage insurance cost every year. So if you have a VA or FHA loan, you don't have 20% into your home. You're probably paying mortgage insurance premiums. Those are now deductible starting in 2026. They used to be deductible before the 2017 Trump tax cuts, but they got rid of that. You've always been able to do your mortgage interest on a house up to $750,000 in value. That still remains. So obviously mortgage interest is still deductible. They're just bringing back the insurance premiums, mortgage insurance premiums as deductible. So that's positive for taxpayers. Now, a negative for taxpayers is charity is a big part of itemized deductions. And they have now put a floor, 0.5% of your adjusted gross income. So you cannot start to deduct any of your charitable donations if you itemize until you've exceeded that 0.5% of adjusted gross income. So your first 0.5 of your AGI is not deductible. So to kind of give you an example, if your adjusted gross income is 100,000, you multiply that by 0.5%, that's $500. So if you give to charity, if you give $2,000 that year to charity and you do itemize, your charitable deduction's only going to be $1,500, not $2,000. So I'm not really sure why they did this, but it is in the tax code. So it makes it, a little bit more difficult to utilize the charitable donation. I think maybe they were trying, some people, one of the big things is a lot of people, you can give $500 of household goods to Goodwill or other entities without having a receipt. So I think a lot of people would always just take that $500. They didn't have to have the receipt. I think maybe something like this is trying to reduce the benefit to do that for people. I'm not sure though. Another thing that they did is the rule used to be if you had gambling winnings, so if you won $50,000 that year gambling, you could deduct up to $50,000 in losses. So if you had $50,000 of winnings, but you had $100,000 of losses, you could at least take 50,000 of your losses to offset your gains. Now, the other 50,000 of losses, that's just gone. You can't deduct it. Well, now what they're doing is they're making it only 90% of losses are allowed, even against winning. So let's go back to the example. You win 50K and you've got 40,000, or let's say 50K of winnings, and you have 50K of losses. Now, under the old tax rules, you basically zeroed out that income. Well, now you can only take 90% of that 50,000 or 45,000. So you're still going to have $5,000 of gambling winnings on your tax return, and you will be taxed on that at ordinary income tax rates. So they've kind of taken away a little bit of the benefit for the gambling losses. The other thing that they did is they got rid of the miscellaneous itemized deductions forever. They're gone. So there used to be a way to, before 2017, before the Tax Cut and Job bill that Trump passed in 2017, you could do your financial advisory fees, you could deduct tax prep fees, and you could deduct unreimbursed employee expenses. That's gone. That's not even an option to do that. It's not going to come back. They just got rid of it completely. Now, if you're a teacher, if you're an educator, there's actually a new category where you can deduct unreimbursed educator expenses as an itemized deduction. Now, we've always had it where educators could deduct $300. It was a separate deduction below the line on their tax return. So that still exists. So if you're a teacher, educator, you can take a $300 deduction still, and you can also do the itemized deductions in case you spent more than $300. So if you spent $1,000 that year and you do itemize, you get the $300 as a deduction for educator expenses, and then the other $700 can be used as an itemized deduction. So that's a good thing for teachers. They've kind of expanded that, so a lot of the teachers who are spending a lot of money in their classrooms can take full advantage of that if they itemize. If you don't itemize, you're still stuck to that $300 basic educator deduction. Okay. Some other little deductions that have been created. Some of them were, things that Trump was talking about. No tax on tips, no tax on overtime. We'll talk about that. They did get put into the tax bill, but again, the devil's in the details. They also brought back the deduction for charitable contributions for taxpayers who do not itemize their taxes. Okay, so let's jump into that. So this was in place for a couple years after COVID, and then it went away. And I've always thought that this was patently unfair, that you had to itemize in order to take a deduction for charitable donations. I always just thought that was not fair to people who maybe rent and they can't itemize. They're going to be on standard deduction. So any charity they gave, they didn't get a deduction. So they've now brought back this deduction. It's a standalone deduction. It's not part of the itemized deductions. So if you do not itemize, you can deduct some of your charitable donations. Okay, so this is good. It's not going to be subject to that 0.5% rule. That 0.5% rule only applies to itemized charitable donations. So this is a dollar for dollar deduction off your taxable income. It doesn't reduce your adjusted gross income. It just reduces your taxable income. So it's $1,000 for single filers and $2,000 for joint filers. So if you're a married couple and you give $2,000 to the church during a year, you now can deduct that $2,000 from your income. Just make sure you keep the receipts. Now, there's a little caveat for itemized deductions. You can, for your charitable component to itemized deductions, it can be cash, it can be household goods. You can donate an auto. You could donate securities. You know, if you had a stock that appreciated, you could give that stock to a charity and then get a deduction for it and not pay tax on any of the gains that you had on that stock. So it's very flexible if you're itemizing. For this deduction, it has to be a cash donation. So if you had growth on a stock and you wanted just to give the stock and avoid taxation on the growth of the stock, you can't do that and take this deduction. You have to itemize to take advantage of that. Okay, so this is just if you're giving cash. It's also not if you're giving clothes and household items to Goodwill. Okay, so tips. No tax on tips. Well, it doesn't eliminate tips from taxes completely, but it does give it a deduction for it. Now, the one thing you have to realize is your taxes will still be subject to Social Security and Medicare. So they're still going to tax you for Social Security and Medicare. It's just not going to be income taxes. This does start this year in 2025 and extends through tax year 2028. So we have about 4 years to take advantage of this. It's a flat rate, whether you're single or joint, up to $25,000. So if you have $25,000 of tips, you can take a deduction off your income tax, regardless of your single or joint filing. So all filing statuses, the maximum is $25,000. It has to be for an industry that customarily receives voluntary tips. So they want to make sure that people aren't going to all of a sudden try to requalify their W-2 wages as a tip in some fashion with their employer. So, you know, you're going to have to be somebody that gets tips, like a valet, a waiter, a bartender, things that we normally would assume would be somebody getting tips. It has to be a voluntary tip. So you can't all of a sudden start asking, like, I'm not going to ask my clients, hey, how about a little tip here for the effort, you know, a little something for the effort. That doesn't work. It has to be one of those situations where it's kind of a voluntary thing and it's flexible. If you give good service, you get a good tip. If you give bad service, you won't get a tip. Now, the one thing that was odd is that the industry classifications, they are not allowing artists, musicians, and entertainers from being able to use this $25,000 tip deduction. Even though that we know that most of these people probably do it. It could be somebody that just is playing music on the street. But a lot of times, you know, if you go to a bar or restaurant, you have a situation where you put a little jar out there and you get tips. Those are not going to be excluded. So that's going to be a little bit of a trip up for some folks because they do get a lot of tips, but they will not be able to deduct it. Now, this $25,000 deduction does start to phase out at $150K for single folks and $300,000 for joint. So there are phase outs for higher income people. Overtime. So again, like tips, it's not completely exempt. It does help, but it's not complete. Now, unlike the tips, there are different figures for single folks and joint. So it's $12,500 if you're single, you can exclude, and $25,000 if you're married filing joint. Again, the $150K, $300K phase outs for single and joint still exist. So it will phase out as your income goes up. Now, the other thing that you have to remember, it's only going to be for your base hourly rate that is above, or it's only for the overtime rate above your base hourly rate. So as an example, if you normally make $20 per hour and then you work overtime and that's $30 per hour, you can only use this deduction to offset the $10, not the full $30. Okay, so only the amount that's attributed to overtime pay, you can include that in this $12,500 or $25,000. Okay, so only the amount above your normal hourly rate. So, a lot of people thought that, okay, I worked 10 hours of overtime at 30 an hour. That's $300. I won't pay tax on that $300. That is not the case. They'll take the 10 hours and then they'll take the amount above your hourly rate, which in this example would be $10. So $100 won't be taxed. The other $200 that you would have gotten at your normal rate is still going to be taxable. So you can see the devil is in the details here, folks. So again, this is just kind of giving you an overview here of the deductions for tips and overtime. You can kind of look at this at your leisure. If you're listening to this in a podcast, if you look at the video, I've got a good chart really breaking this down. And the other thing to remember here is this is only for tax years 2025 through 2028. This goes away starting tax year 2029. So again, it's going to depend on who's in power, what our financial situation is, to see if this would get extended or not. Another new one that's kind of nice, this is for tax years 2025 through 2028, is you can now deduct the interest off an auto loan with caveats. So the vehicle has to be 14,000 pounds or less. So it's not eligible for RVs, for ATVs, or for trailers. It has to be a new car. It cannot be pre-owned. It must be assembled in the United States. So it doesn't mean it has to be fully produced in the United States, but it must be assembled. So there are a lot of foreign manufacturers that kind of put the parts together, bring them here to the United States and assemble them. The way you find out, if you get in the internet, you take your VIN number, and then, there are sites you just sort of Google, where's my car made, put the VIN number in, and it can tell you where it was assembled. The other thing is it has to be new loans after December 31st, 2024. So I bought a new car in 2024. I'm out of luck. But if you bought a car this year, or if you do it later, you'll be eligible for this. You cannot take a loan out on a car that is already paid for. So if you, let's say in January this year, you bought a car and you paid cash, and now you say, hey, I can deduct the interest off the auto loan. I'm going to go back and I'm going to go to my credit union or my bank and get a loan for this car and take the money. Can't do that. It's also capped at $10,000 per year. So if you're spending 10 grand on interest, because remember, it's interest, not the total loan. It's not the principal repayment. It's just the interest. If you're spending more than 10,000 of interest on a car loan, we need to talk. You're a little bit nutty there. It's a little crazy. Okay. So let's just kind of go through all of the deductions that you're looking at on a tax return now. Okay. So when we do taxes this year, these are the things you're going to see. So remember, I talked about above the line and below the line. So above the line deductions reduce your adjusted gross income. And this is important because the AGI then affects everything else, like tax credits, other deductions. A lot of these things, AGI drives the train. So these are the most important deductions. And honestly, every one of these existed before this big, beautiful bill. Okay, so there are no changes here. I'm just giving you an overview of the things you can do as a taxpayer. Okay, so obviously capital losses up to $3,000. So if you have more losses than gains on, say, stock positions for the year, even if you have 100,000 of losses, you can only take $3,000, but that's always been in place. The educator expense deduction that we talked about earlier, still in place, $300 per person. So that's $300 on a single filer, or $600 if both married folks are teachers. HSA contributions are still above the line and fully deductible. IRA qualified plan contributions, student loan interest, 50% of self-employment tax, self-employed health insurance cost, moving expenses if you're an active duty armed forces member. And then there's some other adjustments from Schedule 1 that you can do. So everything is basically the same for the above the line deductions. What's new are the below the line deductions. So the ones that have been in existence even before the big beautiful bill, obviously you either did the standard deduction or itemized deductions. And then if you have qualified business income as a business owner, if you have enough real estate properties to qualify for it, or if some of the securities you own through your brokerage, they can pass along some of their qualified business income deduction to you, usually through a K1. I know people hate K1s, but sometimes there's a little bit of good to it in that you can get some Section 199 deduction. So those have been in place before the big beautiful bill, and they remain. Now, we went through the differences for the standard or itemized deductions, so there are going to be some changes there. There's also some changes to the 199 deductions, but I didn't get into that because it doesn't affect a whole lot of people for this purpose. So some of the new ones in the big beautiful bill, the 65 or older $66,000 deduction, that's good from 2025 to 28. Charitable contribution for people who do not itemize, $1,000 for single, $2,000 for married filing joint. That starts in 2026. Qualified tips up to $25K. That starts this year through 2028. Qualified overtime comp, $12,500 for single, $25,000 for married filing joint. Starts in 2025 through 2028. And a qualified car loan interest up to $10,000 starting this year through 2028. So these are the new below the line deductions that you can take on your tax return. Okay, so that's how deductions now work. The tax credits basically remain the same. There are some little nuances. The child tax credit did go up from $2,000 to $2,200. So, hey, extra $200. Because remember, credits are dollar for dollar reduction in taxes. So that is literally a $200 increase to parents. The other little twist to it is they have now finally indexed this child tax credit to inflation. So from 2026 on, it will go up from $2,200 based on whatever the inflation rate is. The additional child tax credit, this is an additional amount for low income earners. It still remained at $1,700. That did not go up at all. And we still have the same phase out. This credit does phase out once you're $200,000 income for single filers and $400,000 for joint. So you still can get phased out of this if you're a high income earner. One of the other things for credits, the clean energy credits went bye-bye. They're gone. So the $7,500 for a new electric vehicles or $4,000 for used one, that's gone. That's not happening anymore. Same with the alternative fuel vehicle refueling. So if you put charging equipment at your house, you could take up to $1,000 in deductions. Now, they did give you a little bit of a leeway. So you can still use the electric vehicle. I should mention this. I almost see devil's in the details. I almost let a couple of details go. You still have till September 30th if you're going to do an electric vehicle. And you can still do the property credit, the charging equipment, until June of 2026. So you still have a little bit of time, but they're going away, and they're going away for good. They're not it's not one of these that sunsets, comes back in 2028 or 29. They're gone. Same with the energy efficient home improvements. So the $1,200 that you had for, new windows or doors or heating and cooling equipment, That's going away, and that's going to go away at the end of this year. Okay. So you still have a little bit of time if you need a new HVAC system or you're going to get windows or doors. Now's the time to do it this year. And then the residential clean energy credit. This one's a biggie because a lot of people would get solar panels, geothermal heat pumps, those kind of things. At the end of this year, that's going to go away. 30% of that was awfully big. Some of these things can be, $20,000 or more to get them in place, and you would get 30% of that back as a tax credit. So that's a biggie. So these things are gone. Okay, so that's on the credit side. So there's some other little nuances that I think appeal to a lot of folks. The other one little thing's a 529 plan. So if you have children or grandchildren, grandparents can help here on the 529 plan. If it's for secondary school or pre-college, if you will, you can now spend up to $12,000 instead of $10,000 in a year. It used to be you contributed to these 529s, and you could pull out $10,000 if your child went to, say, private high school or private middle school. You could do $10,000 a year. Now it's $12,000. They also expanded what you can use this $12,000 on. Before, it was just for the tuition at private schools. Now they have it in there. You can, if you have required materials that you have to have, textbooks, online education materials, you can use that $12,000 figure to that. Cost for tutoring outside the home. So if you pay to go to a mathnasium or one of these Kaplans or something like that, you can use that $12,000 for that. For standardized tests, AP exams, college admission exams. So if you're taking the SAT, ACT, AP exams, anything like that, you can now use 529 money to pay for that. If you happen to be in a school district that allows you to satisfy your high school requirements, but also get college credit, but there's a cost associated with it, you can now use that money to pay for those college courses. And if your children have disabilities, you can also take $12,000 and get help with occupational behavior, physical, and speech language therapies. So really expanded how you can use this money, which is very good. So even if you don't send your child to private school, you can now see that there's some ways to use this even before they get to college. Some schools might require a certain computer or a calculator or things like that. So these costs can now be used with 529 money. Now, once we're talking post-secondary, so this is usually going to college, but it could also be trade schools or any other school that is officially licensed with the Department of Education. Obviously, as always, tuition fees, books, and other expenses, they've always been eligible for the 529, but there's some new expenses. So fees for exams required to obtain or maintain a credential. This applies to me for my certified financial planner designation, for doctors, for lawyers, CPAs, all of these people can now take money from a 529 in order to obtain or maintain a credential. The other thing is if you have continuing education to maintain that credential, you can also use 529 money. So it now makes sense. I have coursework I have to do every year, and I do pay money for that. So I can now utilize a 529 for that if I want to. Another thing that they did, this pretty esoteric, but for health savings accounts, they expanded the eligibility on this. It used to be you had to have a gold or silver plan to be able to deduct your HSA premiums. They've now extended that to the bronze plans. They've also extended it to catastrophic care. So if you have a policy where it only kicks in for very catastrophic costs like hospitals, cancers, heart attacks. Those plans are now eligible for HSAs. And also, if you're somebody who does a concierge or what they call direct primary care arrangement, where you're paying a retainer to a doctor every year, and then you get special access to the doctor. Before, you could not include that. You could not have that as part. You were not eligible for HSA deductions, basically. Now you are. You're no longer prevented from using a concierge and taking the HSA deduction. So that's a positive. Now, one thing that's completely new is Trump accounts. So this is for if you have children or grandchildren. So it used to be a child could never contribute to a traditional IRA or a Roth IRA unless they had earned income. So you could not put money in their account unless they had earned income. And if they worked at McDonald's for 10 hours a week, they might only make $1,200, $1,500 a year. They could only put $1,200 or $1,500 into their IRA. Well, now this account is for children with no income. So as soon as your child's born, you can use this. You can put $5,000 per year into these accounts for their retirement. And that $5,000 is indexed to inflation as time progresses. Now, you don't get a tax deduction like, if you put money in an IRA, you get a tax deduction. So this does not give you a tax deduction for the parent or the grandparent or any other person that's contributing here. So you don't get a tax break, but you're putting money into an account that's going to grow tax deferred for your child for a long time. The other thing is your child could still have a Roth or traditional IRA if they have earned income, and you could contribute to the Trump account. So you could put that $5,000 in there for your child. And if your child earned $3,000 during a year, your child can contribute that $3,000 to a traditional IRA or a Roth. One of the interesting things is this, you can only invest in an index fund that utilizes U.S. stocks, not even international, just U.S. stocks, and keeps expenses below 0.1% per year. So this is kind of a neat little twist. It's making sure, one, it's going to U.S. based companies. And then secondly, it keeps costs low. So we're not opening accounts where brokers can stick your kids' Trump account money into expensive funds or annuities or other crap like that. Now, you can have no distributions until they're 18. So if you put this money in, there's no way to access it. There's no emergency clauses. There's no special situations. That money goes in, it can't come out. All right. If your child dies before the age of 18, the account is fully taxable the year the child dies to whoever the beneficiary is. So, if another sibling gets that money, it's fully taxable that year. There's no way you can pull that out over time. It's taxable right away. So this gives you just sort of a general idea for the Trump accounts from when the child's born until age 18. Kind of gives you an idea of how to use it. And then what are the rules once a child turns 18? That's when it gets a little bit trickier. So once they're 18, there are some distributions that are allowed, but they are subject to early withdrawal penalties before the age of 59 and a half. Okay, so you can do it, but you're going to be facing some income tax plus that 10% penalty. The direct contributions can be withdrawn tax-free. So the $5,000 that you put in there for your child, they can take that out after 18 without paying tax. Any growth on that is going to be facing taxation plus that penalty. Since you didn't get a tax break putting that money in there, they're not going to tax the child when they take that out as a withdrawal. Before you're 18, again, you have to use those low-cost U.S. equity index funds. Once you hit age 18, you can invest in anything you want. It just acts like an IRA. So you could do any kind of investment. The Trump accounts are not aggregated with other IRAs for distribution rules, so they are completely separate. They're not considered an IRA. The required minimum distribution and 10-year rules, if you inherit one of these accounts, are probably going to apply. There's no language to that yet, so we don't know if it's going to be mandated to have the RMD rules. I mean, I know it sounds weird. You're contributing to a child under 18 and you're already thinking, well, how are they going to pull the money out when they're in their 70s? But we suspect that the RMD and 10-year rules will apply, but we're not sure. There's not definitive law there. There's also no rule yet that we can see if at age 18 that they could just roll this into an IRA. We don't know. That hasn't been clarified yet. So I expect some more clarification on this, but at least we have some general idea of how these things are going to work. Okay. And as always, I've got my little disclaimers there. Always like to have those on. So this one a little bit longer than normal. I do apologize. There's a lot to the tax code. And again, I'm sure this is probably one of the more boring updates, but it's pretty important just so you know what's going on for your taxes, because there's some nice deductions here that you could take advantage of. If you have any questions on any of this information, please let me know. I'll try to be sending out more information to clients of mine through emails and things like that, so they have the information. If you are signed up for my newsletters at savingyourselffromwallstreet.com, if you're not a client, you can sign up there and you'll get this information as well. I'll make sure I pass that along. So I appreciate you tuning in, and we'll talk to you all soon. Take care, everybody.